Welcome to AEI and today's policy event, where we have the opportunity to hear FDIC Vice Chairman Travis Hill's views on current regulatory and resolution policy issues that have arisen in the aftermath of recent bank failures. After a long period of relative calm following the great financial crisis, the FDIC was again in the spotlight as Silicon Valley and Signature Bank unexpectedly failed in the spring of 2023. These failures startled markets and created funding pressures for other banks. As you may recall, these were not run-of-the-mill bank failures, but unanticipated failures of two very large banks that were precipitated by deposit runs. The depositor runs these banks' experiences were not the old-fashioned Jimmy Stewart, Bailey Building and Loan variety, with hordes of retail deposits lining up at bank branch doors to withdraw their deposits as cash, in cash, one by one, but instead they were electronic runs, transfers of very large uninsured deposit balances that happened virtually overnight. The speed of these unanticipated depositor withdrawals left SVB and Signature Bank and other similarly situated banks like First Republic scrambling for liquidity. Ultimately, the Secretary of the Treasury, the FDIC Board, and the Federal Reserve Board declared a systemic risk exception and extended FDIC insurance coverage to all deposits in these institutions. The Secretary of the Treasury went further to infer that this blanket deposit insurance guarantee coverage could be extended to other banks if that became necessary to calm markets and avert a wider banking crisis. Forensic examinations of these bank failures highlighted the need for tighter bank supervision and improvements in the processes banks and the FDIC used to access emergency liquidity. Today, we have the pleasure of hosting FDIC Vice Chair Hill to discuss his views on these and related issues. Travis Hill, our guest today, serves as the Vice Chairman of the FDIC since January 2023. From 2018 to 2022, he served as Deputy and Senior Advisor to the FDIC Chairman for Policy, and before that as a Senior Advisor on regulatory and other policy initiatives. From 2013 to 2018, he served as Senior Counsel at the United States Senate Committee on Banking, Housing, and Urban Affairs, where he participated in drafting and negotiating numerous bipartisan bills. From 2011 to 2013, he was a policy analyst at Regions Financial Corporation. Please join me in welcoming FDIC Vice Chair Travis Hill.
Well, thanks everyone for being here. Thanks to Paul for the kind introduction, and to AEI for hosting this event. The past year and a half has been a pivotal time for the FDIC. With 3 of the 4 largest bank failures in U.S. history, longstanding questions have reemerged about how to address bank runs, and newer questions have emerged regarding how FDIC receiverships are funded. Today, I will offer thoughts on both of these topics, along with views on the FDIC's approach to broker deposits and a few thoughts on the path forward for the Basel III endgame proposal. The bank failures last spring sparked conversation about the Federal Reserve's discount window and bank liquidity rules, among many other topics. Many wondered how Silicon Valley Bank, with a huge stockpile of government bonds, was largely unable to borrow from the discount window before its failure. Subsequent reports from the Federal Reserve and FDIC on SVB and Signature Bank, respectively, described how both institutions were unprepared to do so. The Federal Reserve was originally created to mobilize reserves, provide liquidity to banks, and reduce banking panics, with varying success over time. One prerequisite for this objective to succeed is that banks must be able and willing to use the liquidity facilities available. The lack of use is a multifaceted problem, but the less banks use the discount window in aggregate, the more stigmatizing it is when banks do use it, and the more reluctant supervisors are to allow banks to rely on it as part of their contingency planning. As an initial step to address the issue, following stories of SVB's frantic, last-minute attempts to borrow from the discount window, the Federal Reserve has reportedly been working on operational improvements to modernize the discount window's antiquated operations, such as by allowing banks to make funding requests electronically rather than by phone, and potentially expanding the hours of operation. These type of operational improvements seem like a necessary but insufficient step. Another idea that has been under consideration is a discount window prepositioning rule. This concept is a derivation of Mervyn King's pawnbroker for all seasons proposal, which would require a bank's cash and central bank borrowing capacity to exceed all runnable liabilities. The objective is similar to that of deposit insurance, to remove the risk of runs by removing the risk of loss, but broader in the sense that it would apply to all short-term liabilities rather than just a subset of deposits, and leakier in the sense that it would not completely remove the risk of loss. More recently, in 2023, a number of institutions experiencing stress or negative attention repositioned their balance sheets so that total cash plus borrowing capacity at the Federal Reserve and Federal Home Loan Banks exceeded total uninsured deposits. This was generally a helpful approach to stem deposit outflows, as it removed the first mover advantage that can spark a bank run and helped restore confidence among potentially skittish depositors. However, maintaining such a ratio, while doable in the short term for some banks, would be extremely costly to maintain over the long term for most banks and impossible to achieve even in the short term for some banks. Moreover, moving the entire banking system to such a 100% ratio would radically reshape the role banks play in the economy. The proposal currently being discussed is a derivation of this concept. Presumably in recognition that this type of 100% ratio is unfeasible, the new proposal under consideration would require banks to maintain a minimum ratio of cash plus discount window borrowing capacity to uninsured deposits set at some value below 100%, with news reports suggesting that ratio could be set around 40%. While I think some incentives or requirements for banks to establish access to, pre-position collateral at, and borrow from the discount window is worth considering, setting this type of hardwired ratio seems dangerous. Whereas a ratio above 100% may remove the first mover advantage, at least temporarily, a ratio under 100% amplifies it by shining a magnifying glass on the fact that a bank cannot cover every depositor. If SVB's management said to its uninsured depositors on March 8, 2023, "Don't worry, we have 40% coverage of our deposits," I suspect the reaction from depositors would have been something like, "We better make sure we're part of that 40% and not part of the 60%. Part of the motivation cited for the proposal is destigmatizing the discount window. The Federal Reserve has been working to address stigma for many years, an issue that has existed for nearly its entire history. I tend to think that, at least for large banks, stigma will remain an issue so long as banks do not borrow from the discount window in meaningful volumes and markets can figure out when banks under stress are forced to borrow. A fundamental challenge is encouraging banks to use the discount window so that it is less damaging to use when really needed, but not make it so attractive that the central bank becomes an everyday source of liquidity across the industry. In that vein, while it is helpful for regulators to do more to consistently convey that borrowing from the discount window is acceptable, what message does it send to establish a rule requiring prepositioning, but not incorporate discount window capacity into the liquidity coverage ratio and internal liquidity stress test? I think it makes more sense to consider incorporating discount window capacity into the LCR rather than creating a new liquidity metric for each stress event. If a bank run unfolds at supersonic speed, as occurred at SVB, the discount window is likely to be the only game in town, as only the central bank can create liquidity at scale immediately. Even if the run at SVB had occurred over the course of days rather than hours, rapidly liquidating its huge profile of securities to meet outflows would have been impractical and extremely disruptive to markets, as the FDIC learned firsthand when we assumed and later sold off that same securities portfolio. And even First Republic, which suffered a run that lasted several weeks, primarily met its deposit outflows with Federal Reserve borrowings and was finally forced into receivership when it dropped to secondary credit and lacked the borrowing capacity to continue to meet outflows. Furthermore, selling large stockpiles of a security craters the value of that security and harms any other banks who own those securities. Allowing banks to count loans that are monetizable through the discount window in the LCR could also reduce the trend of forcing banks to buy increasingly large quantities of securities and operate increasingly like bond funds, particularly if the agencies are also planning on ratcheting up HQLA demands through other LCR changes. From a stigma perspective, This would achieve a similar goal of incentivizing banks to pre-position more collateral at the discount window while delivering a more consistent message regarding supervisors' expectations of discount window use under stress. In addition to improvements to the discount window, we should continue to think about other ways that regulators can better manage future liquidity stresses. One example is better access to real-time data. I have spoken in the past about the FDIC's rapid phase prototype competition, which was initiated in 2020 and discontinued by the current chairman, to develop technologies to provide more granular and frequent data, which could eventually have given the FDIC access to real-time deposit flow data. Another option, on potentially a much shorter time horizon, arises from a recent paper by researchers at the Federal Reserve Bank of New York. The paper analyzed which banks suffered runs in March 2023 by looking at interbank payments through Fedwire and ACH. The weekend after SVB failed, I asked officials at the Federal Reserve whether this type of data was available to see deposit movements, and I was told it was not. It would be very helpful if the Federal Reserve can find a way to make this data available in real time for key decision makers, along with capabilities to rapidly analyze it. Among other benefits, better visibility into real-time deposit movements across the system could significantly improve our ability to monitor for runs in contagion and reduce the risk of unnecessarily invoking the systemic risk exception and vice versa. Much like the bank failures last year raised questions about banks' contingency funding plans, or lack thereof, so too did the failures raise similar questions about the FDIC's. Bank failures can occur suddenly and involve significant short-term liquidity demands, particularly in the event of large bank failures or a large number of bank failures. The FDIC faced such a situation last spring when the failures of SVB and Signature, and subsequently, but to a lesser extent, First Republic, placed substantial liquidity demands on the FDIC. The FDIC initially met these demands through borrowings from the Federal Reserve and did not pay off the borrowings in full until nearly 9 months later. The unprecedented nature of these borrowings and the substantial cost incurred have raised a number of questions. An initial question is when and to what extent the FDIC should have drawn from the Deposit Insurance Fund rather than the Federal Reserve to fund these receiverships. The FDIC invests the DIF's funds in non-marketable Treasury securities, which earn a return for the DIF but cannot be traded in the market. In order to access cash from the DIF, the FDIC must redeem the securities with the Treasury Department in exchange for cash. The average yield on the DIF's portfolio last March was slightly over 3%, meaning borrowing at market rates, much less at a penalty rate, was a much costlier option than spending DIF funds. On March 10, 2023, the day SVB failed, cash in the Treasury General Account amounted to $208 billion, several $100 billion lower than usual due to the fact that the outstanding debt of the United States reached its statutory limit on January 19, 2023. The FDIC was able to access some funds from the DIF, but there were significant challenges and frictions in doing so because of sensitivities related to the debt ceiling and Treasury's cash position. The FDIC ultimately withdrew approximately $52 billion from the DIF in multiple installments between March and May, amounting to approximately 40% of the funds in the DIF when SVB failed. I will offer 3 observations on this point. First, it seems the FDIC could have accessed more cash than Treasury provided, given the level of the TGA in March, and perhaps the FDIC should have insisted on it. Second, in the event Treasury could have provided more cash, or in a future event, the level of the TGA is smaller, the FDIC and Treasury could have devised a plan for Treasury to, at one or more upcoming auctions, first, redeem the FDIC's securities for cash, and second, on the same day, issue new securities into the market. As others have pointed out, redeeming securities from the DIF lowers the national debt and creates more space under the debt limit for the Treasury Department to issue new securities. Under this scenario, the FDIC would need to borrow from the Federal Reserve or another outside source for a few days until the cash proceeds from the securities issuance or issuances arrived. Third, and most fundamentally, the FDIC should have unfettered access to funds in the DIF. Perhaps, rather than rely on the Treasury Department's ability to redeem the DIF's securities for cash, another option might be for the FDIC to leave funds in a deposit account at a Federal Reserve Bank. This would ensure the FDIC could access and deploy DIF liquidity on very short notice, including after business hours and over a weekend. While many government agencies spend much larger sums than the FDIC, I am unaware of any that has the same potential for very large, unexpected liquidity needs that must be met immediately, with the one possible exception, the Federal Reserve itself, which serves as the lender of last resort precisely because it can create its own liquidity. A related question is how far the FDIC should deplete the DIF's liquidity to meet short-term receivership needs. Even after the debt ceiling was resolved, the FDIC continued to pay the Federal Reserve's penalty rate for 6 more months before finally using the DIF to fully pay off the Federal Reserve at the end of November 2023. In the immediate aftermath of the March 2023 failures, I think it was understandable to be cautious, but the justification for caution decreased significantly over the ensuing weeks and was mostly gone by the summer. More generally, I suspect we may overestimate the impact that the DIF's temporary liquidity position has on depositor confidence, and if the FDIC is reluctant to use funds in the DIF for bank failures, what would this mean for our entire assessment framework? Even if the FDIC had been able and willing to use all the funds in the DIF, the FDIC still would have needed to access additional liquidity. I should underscore that this was solely a liquidity issue, as the FDIC's assets also included all the loans, securities, and other assets assumed from the failed banks that we would subsequently sell or monetize to pay off borrowings. The most obvious places the FDIC could turn are the Federal Financing Bank and the Treasury Department, which would have charged a cheaper rate than the Federal Reserve's penalty rate. Before the debt ceiling limit was raised, the Treasury Department could not have issued new debt to finance any FDIC borrowings from the FFB or Treasury. But, as noted earlier, the Treasury Department still had considerable cash in March, which, in addition to being used to redeem the DIF securities, could also have been used to lend to the FDIC. Nonetheless, the FDIC chose to continue paying the Federal Reserve's penalty rates for months even after the debt ceiling was raised, rather than borrow from the FFB or Treasury. The decision of whether to borrow from the FFB or Treasury is one the FDIC has faced before. From 1991 to 1993, the FDIC borrowed from the FFB without any adverse market reaction, while in 2009, the FDIC chose not to borrow from the FFB or Treasury due to fears around the optics of borrowing from Treasury. In 2023, the FDIC made the same choice for similar reasons as 2009. Of course, every circumstance is unique, but I suspect we overestimated the negative consequences of borrowing from the FFB or Treasury in 2023, particularly after the debt ceiling was resolved in June, and especially given the DIF's net worth was nowhere near zero. A related option is to securitize assets through the FFB, a process in which the FDIC, in effect, sells the right to future cash flows with an FDIC guarantee to the FFB in exchange for cash, while retaining ownership of the assets. This allows the FDIC to monetize the assets faster than selling them into the market, particularly for illiquid assets, and avoids the risk of disrupting markets. The FDIC securitized approximately $50 billion in assets through the FFB in September 2023, and an additional $47 billion in January 2024. This could be a useful option in the future if the FDIC and FFB can execute such transactions much more quickly, ideally over resolution weekend, or if not, within a few days of failure. Ultimately, the Federal Reserve funded the receiverships. More specifically, the two bridge banks borrowed extensively from the Federal Reserve to satisfy deposit outflows, with those borrowings guaranteed by the FDIC, while First Republic, as mentioned earlier, borrowed extensively from the Federal Reserve prior to failure. The three receiverships assumed those borrowings, which combined amounted to $273 billion in total, which the FDIC ultimately paid off in November 2023. When the bridge banks were dissolved and when First Republic was sold, the Federal Reserve viewed the advances as in default, which, under the Federal Reserve's operating circular, results in a 500 basis point increase in the interest rate charged. After some negotiation, the Federal Reserve reduced the penalty rate to 100 basis points. Yet, the FDIC fully guaranteed the borrowings, and as banks are required to tell their customers, the FDIC is backed by the full faith and credit of the US government. The 100 basis point penalty rate was extremely costly given the volumes involved and the time it took to pay it off, ultimately costing the FDIC roughly $1 billion. In effect, this was a shadow tax on the banking industry, primarily charged through the special assessment, that in the short run decreases the Federal Reserve's losses and in the long run increases the earnings the Federal Reserve sends to Treasury. The FDIC could have considered additional options, such as borrowing from the private sector or from the federal home loan banks, neither of which it appears the FDIC seriously considered or had ever prepared to do. It is clear there are a number of lessons to be learned from this experience, perhaps chiefly the importance of doing much more advanced work for this type of scenario. Given that this was not the first and is unlikely to be the last time the Treasury Department has dealt with debt ceiling issues, and given the possibility we could have much larger banks fail in the future, we should have a plan in place to immediately access DIF funds when the debt ceiling is in play, and we should have other backup options in place. The FDIC has an obligation to minimize losses when resolving failed banks, and it is hard to argue that that is what we did here. Next, I will offer a few thoughts on broker deposits. The broker deposits framework was first put in place by Congress in 1989. 35 years later, I believe that the regime is no longer fit for purpose. Broker deposits are deposits that are placed with a bank through or with the involvement of certain types of intermediaries defined as deposit brokers. The principal consequences of a deposit being classified as brokered are first, a tax in the form of higher deposit insurance assessments and more punitive treatment under liquidity rules. Second, limitations on the ability of a bank to accept such a deposit if the bank falls below well capitalized. And third, in some cases, a reflexive judgment by examiners that the deposit is risky. The first is provided by rule, the second required by statute, and the third varies by examiner and agency. The regime suffers from a number of flaws. First, whether a deposit comes to a bank through an intermediary is not the key test in determining what type of risks it presents. For example, SVB suffered a deposit run in part because it relied heavily on large, concentrated, closely networked uninsured depositors. Whether any such deposits came in through intermediaries was not a relevant factor. In fact, when SVB failed, not a single one of its deposits was reported as brokered. Second, the deposit landscape now encompasses a broad range of deposit arrangements, many of which involve third parties that bear little resemblance to traditional deposit brokers. In the 1980s, the term broker deposit was commonly understood to refer to a specific market in which third-party brokers gathered and pooled funds and placed them into brokered certificates of deposit issued by banks. At the time, Congress could use a broad definition of deposit broker and could broadly exclude those whose primary purpose was not the placement of deposits, because deposit brokers represented a well-understood universe and few others were engaged in the business of placing and facilitating the placement of deposits at the time. Most deposits came into a bank when customers walked into a local branch. However, since then, the internet, smartphones, and other innovations have revolutionized how banks interact with customers, with many types of deposit arrangements now involving intermediaries. The emergence of new deposit arrangements over the years has continually put pressure on the broker deposit framework. Prior to the 2020 rule, the FDIC addressed each new arrangement on a one-off basis, resulting in an unwieldy, opaque regime inconsistently applied across the industry. The 2020 rule brought structure, process, and order to a disorderly regime, but a fundamental problem still exists. It is incredibly difficult to make sweeping judgments on which side of the line every new arrangement falls in a fair and risk-sensitive way. Today, different types of deposits currently classified as brokered present, in certain respects, diametrically opposite characteristics. Some types of broker deposits raise safety and soundness concerns out of fears they are volatile, unstable, or otherwise likely to be withdrawn if the bank experiences turmoil or negative attention. On the other hand, traditional broker deposits present the opposite concern. The deposits have no franchise value because the depositors have no relationship with the bank, earn high rates, are fully insured, generally cannot withdraw before maturity, and thus are generally indifferent to the condition of the bank, but are incredibly stable. Meanwhile, as discussed earlier, regulators have been trying to encourage more discount window borrowing for banks experiencing funding stress. But yet the FDIC may push further to prohibit the use of broker deposits for essentially the same purpose. From a contingency funding perspective, each has trade-offs. The discount window can provide funds faster and at unlimited volume, but suffers from greater stigma. Yet both are generally high-rate liabilities for the bank and are more or less equally costly to the DIF if the bank subsequently fails. In either case, the funding generally has no franchise value and gets paid off in full upon failure. Additionally, deposits gathered through a listing service website have never been treated as brokered, meaning a bank that falls below well-capitalized has no regulatory restrictions on its ability to obtain deposits through such a website by offering the highest rate, essentially the problem the broker deposits law was initially intended to address. Banks are sometimes encouraged by supervisors to seek out listing service deposits once they become subject to broker deposits restrictions, which I think demonstrates that this whole regime does not work. That all being said, we should not view the deposit franchise of a bank that funds itself entirely with traditional broker deposits the same as that of a bank that funds itself entirely with, for example, retail deposits from a diverse branch network. But I do think we should make an effort to modernize how we think of a bank's funding mix and to think more holistically about how we view a bank's deposit franchise. We could consider doing a new study on deposits similar to the FDIC's 2011 study, though hopefully with a more open mind about broker deposits. And I continue to be skeptical of sweeping policies restricting a bank's access to certain sources of liquidity as its condition deteriorates. I am generally supportive of the proposal suggested by Chairman McWilliams in 2019 to replace the broker deposits regime with a growth cap, which would ensure banks in poor condition could not attempt to grow out of their problems, but would allow them to meet deposit outflows in an orderly way. I also think it would be a mistake for the FDIC to substantively reopen the broker deposits rule. Doubling down on the pre-2020 broker deposits regime in 2024 is like doubling down on stone castles after the invention of cannons. Finally, I would like to briefly address the Basel III endgame proposal. It's clear that the proposal, issued almost exactly a year ago, lacked appreciation for its real-world impacts, and I appreciate the widespread acknowledgement that broad and material changes are necessary. I agree with calls from many others that a reproposal is necessary. Given the nature, complexity, and extent of changes needed, we should allow the public an opportunity to provide feedback on what the agencies are considering. In particular, the proposed operational risk and market risk frameworks rest on a complicated set of formulas and metrics that would be challenging to amend in a broad, material, and rational way without receiving additional feedback. Addressing the services component of the operational risk framework, for instance, could have a profound impact on various business lines at banks, depending on how the agencies choose to modify the formula. And seeking additional comments would help ensure the agencies understand the consequences of any such modifications. I am skeptical of reproposing only parts of the rule. While some changes may be relatively straightforward and, in isolation, may benefit less from additional feedback, everything in the framework is related. For example, commenters might react differently to certain changes in the operational risk framework if they know the agencies plan to adopt other changes to the credit risk framework, and vice versa, given that both frameworks impact the capital charge associated with the same exposures. Additionally, I strongly believe any reproposal should be issued jointly by all three banking agencies. For just one agency to repropose, but with an expectation that a future final rule will be issued jointly by the three agencies, would be unprecedented, sow confusion, and lead to a number of practical and legal questions. In addition to broad, material, rational changes to the Basel III endgame piece of the proposal, I also think any reproposal should fully reverse the proposed reversal of tailoring of the capital framework for large banks. At a minimum, the agencies should not reverse the 2019 capital simplifications rule, and Category 4 banks should not be subject to the new market risk framework unless they have material trading activities, SACR, or the proposed expanded risk-based approach. The extreme volatility of a two-stack approach in which a bank might ricochet back and forth from one standardized framework to the other does not make sense for Category 4 banks especially given that the expected capital impact is quite small. Thank you for your time today, and happy to answer any questions.
Thank you. Thank you very much, Vice Chairman Hill. There's a lot to digest there. I very much appreciate your remarks, the detail you've gone into. I haven't seen that anywhere else. And I think I want to start with a question about FDIC funding, emergency liquidity funding. One of the reasons that the liquidity demands were so large was in part that the FDIC the systemic risk exception put a blanket guarantee on all deposits. And so all the very large deposits in SVB and Signature Bank could leave, and the FDIC had to fund them. One of the market's reactions to the deposit guarantee might have been they left their deposits in the bank, but apparently they didn't. A couple of questions here. One, maybe next time when the FDIC and the Federal Reserve Board and the Secretary of Treasury are discussing, well, hopefully there's not a next time, but probably there will be, a systemic risk exception, couldn't the FDIC insert a line there that says, and the Fed will fund it without any penalty rate if we need the emergency liquidity? I mean, that could be part of, that's one thing to consider. Another point to consider is the debt ceiling, and I actually wrote about this in March when the FDIC discount window funding went through the roof, and I said, this is unusual. Usually the FDIC funds itself in other ways. It looks like the Fed's funding these banks' receiverships, and it turned out they were. You couldn't use the federal finance, so the FDIC funds receiverships in a number of ways. It's got the DIF. You explained how the DIF has to get the Treasury to refund securities because they're not marketable. The Treasury didn't want to do that. It has the assets from the receiverships that it could liquidate, but that takes time. And often when you get a bank in quickly, you don't know what the assets are really worth. It takes time to market them. You didn't have a buyer for the two banks, obviously. But the federal financing bank is in law a way the FDIC can fund it. Now, the federal financing bank, the FDIC posts collateral with the Treasury, and the Treasury issues bonds backed by the collateral. The FDIC has the assets from the receivership. So, in some sense, federal financing bank really isn't part of the national debt the way the other bonds are that they're borrowing because they don't have taxpayer revenue to pay the expenses of the government. It's a fully collateralized borrowing. I mean, isn't there some way maybe that next time there's an appropriate bill running around the Congress that maybe you get the FDIC's federal financing bank funding to be excluded from the debt ceiling calculation because it's fully collateralized. It's not exposing the taxpayers to future taxpayer liability. It's not the same animal as normal Treasury debt. I wonder if that might be something to think about. A couple of those things to think about.
So I think that's a lot of interesting proposals introduced there. I think on the first point, I think from my perspective, I think what's important is we should be trying to plan for all of these contingencies now. I think it does raise an interesting question of if there was a systemic risk exception invoked prior to that, if one agency said to the other agency, we want to strike the deal on how this is going to get funded. It's sort of interesting, the leverage might go in multiple directions. I think the ideal thing would be to try to work this all out in a collaborative way during peacetime, so that if this happens in the future, it's
something you don't have to deal with.
Exactly.
Obviously.
And obviously from the FDIC's perspective, I think it seems a little unjustified to have charged the penalty rate. But again, I think hopefully that's something that we can continue to negotiate over, months and years in advance of whatever the next, whenever the next crisis is, which, agreed, hopefully not anytime soon. I think on the question of whether, lending to the FDIC could be exempt from the statutory debt cap, I mean, I think there's a reasonable argument for that. My guess is there are probably a lot of agencies that would want to, want that.
But these are fully collateralized. This isn't something
Well,
that
yeah,
taxpayers are going to have to pay for.
Yeah, I think.
Because these loans are over collateralized when you fund them.
I think it depends. I'm not sure that is necessarily the case, but I think either. I think either way though. I think the spirit, the reason why it bumps up against the debt limit is either way they have to finance the cash that's provided to the FDIC. But regardless, I mean, I think it's certainly an interesting idea.
You made me think of that given your talk, so
Yeah.
I'll blame it on me. But
Yeah.
you're the one that sparked that thought in my mind. So, discount window for the banks when they need emergency liquidity. The Fed's got proposals out, mostly to encourage banks to use it. I guess there could be regulations somehow involved, as you mentioned, that you think wouldn't be all that beneficial. Is there some way to use deposit insurance pricing to incent the banks to make sure they have the procedures in process and ways to get collateral quickly across? Can they get a break on insurance pricing? A few basis points here or there. Does the FDIC have the power to do something like that to encourage that? If that's a benefit?
I think that's an interesting question. I mean, it is something we would have the power to do. I think generally the policy objective of trying to find ways to either require or incentivize discount window access, I think is a helpful thing to think about. I think when it comes to the deposit insurance pricing, we try to keep those empirically based and based on sort of the history of what types of things are predictive of losses to the DIF. I think when it comes to establishing access to the discount window, I think that that's something that we would probably want to study pretty closely. I think obviously a big part of the point of trying to encourage more discount window access is the hope that it will reduce the risk of failure and allow more banks to withstand deposit outflows and other types of turmoil. But I think what we would have to think about is, all right, to what extent does it reduce the risk of failure? And then if the bank subsequently fails, then what impact does that have on the DIF? And I think that is, the second piece of that is going to be a little bit mixed, because on the one hand, certainly the hope is the discount window could enable more orderly failures where more potential acquirers can bid and you ultimately can sell the institution at a better price. The flip side to that is, if a bank is replacing deposits with discount window, that typically is going to be more expensive to the FDIC. And so again, it's probably all going to depend.
I think that's true. I'm more speaking the Fed's. Some of the proposals out there are proposals that suggest that discount window borrowing should be more frequent and more common among banks, so that it doesn't have a stigma.
Yeah.
That's not really what I'm talking about. What it turned out was they found out that some of these banks didn't have a way to get collateral to the discount window in time because they didn't have the connections, they didn't have the processes in place. They didn't know what their collateral was, or they weren't talking to the Fed. I'm talking more not about using the discount window to take away the stigma, but just ensuring as part of the safety and soundness examination process that these banks have tested ways to use the discount should they need it, quickly during the day. And I'm really more talking about the technicalities of access rather than demonstrating usage. But anyway, it's something to think about. There's a lot to think about, and I have a lot of questions, some very long ones from the audience here, so I'll limit myself to just a few more. The liquidity problem here, we've talked a lot about access to the discount window, but is there some other way to prevent, to stymie the runs in some way or not? Back in the great financial crisis, the FDIC did subordinated debt guarantees that required a systemic risk exception. Now, there are people now that argue that the deposit insurance limit it doesn't really matter that much. If it's a big enough bank, the FDIC is going to sell it. It's going to sell the deposit franchise. Everybody's going to be covered anyway. So people have the impression that big deposits are going to be covered, except when there's a run like there was, and there's no buyer, and then everybody freaks out, and there is a run, and then you do have to blanket guarantee to stem the bleeding. Is there some way that maybe you could think about the subordinated debt program that the FDIC had that they actually made money on? They made quite a bit of money, I think, guaranteeing holding company subordinated debt back in the day after the great financial crisis. Is there a way to do some kind of program where we have a special collateralized account for large accounts at banks, where maybe there's some extra deposit insurance premium for those, maybe there's some collateral requirement the FDIC imposes, but maybe just recognizing and pricing the fact that large deposits could get insurance coverage under some kind of specialized program. I mean, Bill Isaac, I think, a former FDIC chair, says, well, all non-interest paying transaction accounts, big accounts, should be fully insured. That's his view. But maybe is there some way to create a program, like the Treasury had tax and loan accounts back in the day that had to be collateral. Is there some solution there where you can keep large banks, large deposits from running by creating some sense or some way for them to get insurance? Maybe charge it for it?
Yeah, so I guess the first thing I'd say is I think any of those types of ideas would require Congress. After 2008, the authority to do either a debt guarantee program or a broader deposit insurance program got removed, got taken away. And so now you need to go through basically a congressional approval process to be able to do any sort of basic guarantee program, whether it's deposits or subordinated debt, that would, beyond what the FDIC currently guarantees. I think in terms of some sort of expanded program, I think the proposal the FDIC came out with last year, which is, not quite as specific as Bill Isaac's proposal, but is sort of in a similar vein, the idea of some sort of expanded coverage for business accounts. I think that's a pretty interesting idea that I think if you're going to expand deposit insurance, that's probably the way to best achieve the policy goals, because those are the types of deposits that if losses are imposed on them, it can have these sort of cascading economic impacts where you've got a bunch of businesses that if they lose their operating account, then that business goes out of business. Then all the people who work there lose their jobs, and you have these, and especially if you've got a bank that has a lot of those accounts, then it can have a much bigger impact. Whereas just raising the threshold from say $250,000 to $500,000, I'm not sure that is really all that targeted to what we're trying to achieve. On the collateralized deposit idea, that's interesting. So today, a lot of banks do offer, do have programs where they have collateralized deposits. There's a lot of municipalities that are required to put their funds in collateralized deposits. So those are fully collateralized. We at the FDIC don't have great data on how those types of deposits have behaved. But I think that's something that is worthy of further study. And I think when we look at banks that are experiencing stress or experiencing deposit outflows, collateralized deposits, at least just in my sort of anecdotal experience, seem to behave more like insured deposits than they do like uninsured deposits, at least in the sense that they don't view the deposit as a deposit where there's a risk of loss. They may still pull out their deposits if the bank is deteriorating, but not necessarily because they're viewing it as uninsured. But the idea of whether expanding deposit insurance could come along with some sort of like collateral requirements,
or a price, even a price,
yeah,
some price that the bank would pass along if it was an option.
Right.
I don't know. It would just deal with both sides of the issue, maybe. I'm going to ask one last question before I go to the audience questions. And You mentioned on broker deposits that really the thinking there, the distinction there is really 20, 30 years out of date, maybe more than that. But you really, how you kind of mentioned, I thought, that you didn't want to go with rulemaking again. That took a lot of time. So how do you want to change the way broker deposits are going to be treated if you don't go through the formal rulemaking process or whatever? What
Yeah,
could be?
so my general view is I think that Section 29 of the FDI Act, which is the broker deposits statute, I think that framework just doesn't really work. And so I think ultimately in the long run, my recommendation would be that at some point Congress should change that. And the idea that Chairman McWilliams had suggested was to replace Section 29 with some sort of growth restriction. So as the bank's condition deteriorates, instead of being cut off from this like one very specific form of funding, but not from other types of funding that sort of serve a very similar purpose, instead just put like an asset growth cap that says, all right, you can still access all these types of funding, but you can't use those type of funds to try to grow out of your problem, which then if they subsequently fail, increases the cost to the.
But don't you need to do rulemaking for that? Aren't you opening up the rulemaking
Well,
process?
yeah. So I think Congress would have to change that, and then if Congress changed that, then for sure we'd have to update our rules in addition. But the point that I was making in the remarks about not opening up the rule now is, I feel like the current rule does a reasonably good job given the statutory framework that was created for us, but it still runs into these constant problems of a new deposit arrangement comes up, and it's just very hard to make judgments for every single new arrangement, and then at the end, like no matter how perfect the rule is, you're still going to end up with a regime where there's just inconsistencies in terms of like who's on which side of the line. But to me, it's like the idea of trying to reopen that to like go back to the pre-2020 regime is, that would be a substantial undertaking, and it just seems like that is not a good use of our time and effort, given all the other things that we could be focused on.
So you want some congressional direction there, some language in law that directs how you should.
In the long run, yes.
Yeah, that would be great. Okay, we have questions here from the audience here. How about right there, wait for the microphone. Maybe you could tell us who you are first and then ask your question.
Thank you. Hi, I'm Cheng Cheng from the University of California, Los Angeles. I study economics. And Mr. Hill, thank you so much for coming to today's event, and also to Mr. Kupiec for excellent questions. I do have a question that's kind of my personal interest. Mr. Hill, so you are likely aware that the use of AI in the financial services sector has been a growing area of concern for federal financial regulators, including the FDIC. So my question is, do you think that existing regulations, such as those related to anti-discrimination and consumer protection, are sufficient in regulating AI use cases in the financial services sector? And if not, what approaches do you think financial regulators like the FDIC should take when it comes to regulating AI use cases?
Yeah, that's an interesting question. I guess I would say at the outset, I think it is something that is a cause for both concern and optimism. I think people recognize that there's a lot of promise that could come from AI, but there's also a recognition that there could be downsides as well. I think when it comes to the anti-discrimination and consumer protection policies, it certainly raises some interesting questions, and these are not necessarily new questions. I think, as sort of like lending has moved increasingly towards, models and away from, sort of like interpersonal decisions, the question of like how you translate our approach to, the development of models, I think creates some interesting questions. And I think that's something that is probably going to be dealt with over a period of years, and probably will need to continually develop alongside the technology. So that's maybe not the most satisfying answer, but I think it's something that probably will evolve over time.
we have another question? No questions? I'll go to the questions from the online questions. We have 2 or 3 questions online that really are about the 250, I brought it up a little bit earlier, the 250 deposit insurance limit, and the fact that in the majority of cases, the FDIC knows ahead of time that a bank's in trouble. It markets the bank, it sells the bank franchise, and all deposits are covered. And this leads many to believe that all deposits are covered. And isn't this the whole, shouldn't you just cover all deposits instead of leaving this ambiguity out there, or isn't this a problem? I mean, this is sort of the crux of 2 or 3 online questions that, the way we resolve banks leaves big depositors sometimes to believe that they're covered, or they will be covered, they'll be taken care of.
So I think it's definitely a problem. I think the idea of covering all deposits is not a realistic one for probably a few reasons, but one of the reasons is, then that creates an incentive to basically try to transform like all liabilities in the financial system into bank deposits, and then you're not just insuring all deposits, you're just like insuring the whole country. So I think there have to be some limitations on it, but I think from a policy perspective, and I think if at some point there is a reopening of deposit insurance reform, I think trying to find a way to correct this perception that that most deposits are fully insured, but some of them are not. Like specifically, if you have a large uninsured deposit at a very small bank, I think that is a big problem, and finding ways to correct the, I think right now the regime sort of encourages that, and I think there are probably some creative things that can be done, but that's probably again a longer term thing that definitely would require congressional action.
People have been fighting with this problem more or less for quite a while now. So here's another question from the Zoom audience. How might proposed changes to liquidity rules impact smaller regional banks differently from larger national institutions, and are there concerns about unintended consequences for community banking?
So I think that would depend a lot on what the ultimate changes are and which banks it influences. So there's potential changes to the liquidity coverage ratio, which could involve expanding that to more banks, but certainly would not expand that to community banks, or at least what I would think of as smaller regional banks. The prepositioning rule, which I talked about, also, again, it's all going to depend on the details on how far, what the scope of that rule is and to what extent it applies to banks across the industry. But I would also be a little bit surprised if that applied to community banks. But I think there's often, what often happens is rules get applied to the larger banks, and it gets applied through the supervisory process to small banks. So
trickle down regulation.
Yeah. And then there's just the possibility that non-rules but just shifts in supervisory approach could be applied across the board. So I guess the answer is it really all depends on how things unfold over the next few months to years.
So we have a very long question from a very well-informed person who used to work at the FDIC in a senior position. It's not me. Basically, big deposits can leave quickly. There's not any good solutions that fixes that in the age. If you have with electronic means to move money quickly, it's only going to get worse. And here's kind of the question: should the FDIC, Fed, and Treasury consider a change in the deposit rules such that under certain circumstances and/or balances over the deposit limit be modified or restricted so these at-risk depositors cannot completely withdraw their funds in a short period of time? This is sort of the would be a counter kind of weight to the money market mutual fund
Yeah,
gate type
well,
rules.
that was the first thing that I thought of. I mean, I think we saw what happened when that was tried with money market funds, and it accelerates. Once people start to get concerned that the bank might gate their funds, that pours gasoline on the run, and so yeah, I'm pretty skeptical of any efforts to try to like restrict the ability of people to withdraw funds that they have an expectation they will be able to withdraw.
Okay, we have another question from the back here. Thank you.
Hey, Vice Chairman Hill. Good to see you. Scott Eckel with Charles Schwab. We've been talking a lot today about how do you deal with these uninsured deposits that were at the core of a lot what went on in spring of last year. And we're talking about the consequences of having them and how do you deal with them then. But is there another way you could look at it where you implement policies that would incent to have a higher percentage of insured deposits in the first place, or penalize having a low percentage of insured deposits in the regulatory process? For instance, in the way, say, the long-term debt rule was structured, where you could kind of have some weights in there, or however you would, how you describe that, but where it would incent a higher percentage of insured deposits in the institution in the first place.
Yeah. So in the long-term debt proposal, that was a question that was asked, and was an idea that has gotten a little bit of consideration of sort of like toggling the calibration based on level of uninsured deposits or other characteristics. I think at a very high sort of like systemic level, I think most uninsured deposits, at least by volume, are going to be uninsured one way or another. I mean, unless they use one of these, reciprocal networks to basically like carve it up to get deposit insurance. So, I mean, there are certainly things that the agencies can do that can either penalize uninsured deposits or penalize certain types of uninsured deposits. But I think I think it's, at the end of the day, for large corporations or even mid-sized and small corporations that have operating accounts above $250,000, there's no real mechanism, again, putting aside the reciprocal networks, like that deposit is going to have to go to a bank somewhere. So, penalizing uninsured deposits doesn't make the uninsured deposits disappear. It just kind of moves it from one bank to the other. So,
Could it at least lead potentially to less concentration of a bunch of these large uninsured deposits together in one place?
Possibly, but I mean, my guess is that there are a lot of very large banks that have lots of uninsured deposits, and if you try to get those banks to reduce their uninsured deposit percentage, like there would have to be another very large bank to take all of that volume.
Yeah. If you wanted to put 20% down on the median house in DC or Fairfax County, you'd have to have over the deposit insurance limit in your checking account to do it. I mean, $250,000 just isn't that much money anymore, if you get right down to it. And if you're running a business and you have to meet payroll, I mean, most people don't have that much money in their checking account because they don't need it, but even normal people, for some transactions, you might have to, for a blip of time, exceed the limit. So, I mean, it's an issue, and we've come to 3 o'clock, and I don't think we're going to solve it in the next 30 seconds. So let me thank Vice Chairman Travis Hill for here. I really enjoyed his talk. It was very forthcoming in what went on. I haven't seen that discussed in the detail he did. I thought very informative, and I very much appreciate it. And let's thank our guest.